The death of the old financial system and the birth of a new one called cryptocurrency. We're going to break that down in today's video. My name is Coach JB. What I work to do is make the complex simple. And this week, we've had a series of videos really breaking down exactly what's happening with the financial institutions. I'm going to show you all the way from 1913, based on my logical circuit, to where we sit today, 2023, and the radical transformation in our financial system. But before we do, make sure you use discernment. We will never proactively DM you. Those are all scammers. We do not have an investment platform. Only in the description of this video, I have a Warrior Academy where I've helped over 7,000 warriors worldwide transition into this new brave world, getting their shit together, an education academy. I also have a licensed insurance team helping people understand how we protect, grow, and multiply our wealth with our cryptocurrency gains called Index Universal Life or Infinity Banking Concept. I'm a licensed licensed insurance agent, and I have licensed teams all over the United States to help you. That's a free consultation down below. All right, so let's dive right into it. So if you do not have a pen and paper, please go get a pen and paper out. So I'm going to break this down from my logical circuit, facts, figures, numbers, logic. This will be a longer video, okay? I wanted to do this series of videos just to help educate people, right? We're over the fact that our uncle and our mom and dad and our financial advisor and our tax accountant told us cryptocurrency is a fraud. Guys, there's a dramatic shift in your financial system, and many people are not willing to accept it. If you're willing to accept this and understand at a very deep level that you have the opportunity to invest very carefully, very strategically, when you understand what you're doing through being an intelligent investor, you could radically transform your family's life. But remember, rich parents have rich kids, poor parents have poor kids. If you don't rewire the foundation, you're going to end up in the same situation. So this is called financial education. You're not going to learn this in school. You're not going to learn this at the bank. Your financial advisor isn't going to break this down, nor is your tax accountant. So I'm going to break down the facts, figures, numbers, logic. And I'm not being disrespectful to tax accountants because my accountant's badass. By the way, my accountant kicks ass. But anyways, so let's dive into this. So let's first start in 1913. So if you have your pen and paper out, I highly recommend you pause this video and get a pen and paper out, okay? Because this type of financial education, if you do this 20 minutes a day and you educate yourself, you'll be in the top 5% in expertise. Understand that, okay? So the Federal Reserve was created in 1913. The Federal Reserve System, as a central bank of the United States, provided the nation with safer, more flexible, and more stable monetary financial system. The law sets out proposed structures and functions of the system, as well as outline aspects of its operational and accountability. Congress has the power to amend the Federal Reserve Act, which it has done several times over the year. The complete act, as amended, is provided in the section. So you can go through and read the whole act if you want to, but the Federal Reserve it's not a branch of the government, but it's oversighted by Congress, okay? So 1913, the Federal Reserve was created. That's very important. Now, an interesting dynamic to look at is since 1913, when the Federal Reserve was created, this is kind of weird. The value of your dollar, the buying power of your dollar has collapsed dramatically since 1913. So since 1913, the dollar had power, and then it dropped down in 1918. It popped up right after the Great Depression. There's always a little pop after a big financial collapse, which I think we're heading into a big similar outlook, which I'll break that down in just a moment. So look at 2020. It literally has declined dramatically since the beginning of the Federal Reserve. Isn't that interesting? Since 1913. So this is the buying power of your dollar as your productivity has gone through the roof, okay? Specifically since 1971, if you take a look right here, you're seeing just a dramatic decline, and we've had some big shifts over the past 3 to 4 years in our financial system, okay? So you saw the 1913, the Federal Reserve was created. You see the decline over time, and then we had the banking panics of 1930 and 1931. This was after the Great Depression, okay? Now, the Great Depression is a very important factor in this, right? In the fall of 1930, the economy appeared poised for recovery. The previous three contradictions. So think about the familiarity, guys. 2020, what happened? We had a pandemic that shut the whole world down, which I'm going to break down, right? We were supposedly poised for recovery. Inflation, boom, went through the roof. They shut off the printing machine. Banks started to bail in, a monopolization of the banking system. Well, the same thing started to happen. When the crisis began, over 8,000 commercial banks belonged to the Federal Reserve. There was nearly 16,000 were not part of the Federal Reserve. Those non-member banks operate in an environment similar to which existed before the Federal Reserve was established in 1914. The environmental harbored the cause of the banking crisis. So think about the familiarity now, non-bank financial institutions. So if you're not part of the system, you're going to get destroyed. What are they doing right now? Protecting us from speculators, non-bank financial institutions, which I'll break down in just a moment. So there were 16,000 that weren't part of the system, that weren't controlled through the Federal Reserve, and they basically collapsed. Those banks collapsed. One cause was a practice. This sounds very familiar, right? The practice of counting checks and the process of collecting as parts of the bank's cash reserve. The floating checks were counted in the reserves of two banks, the one in which the check was deposited and the one which a check was withdrawn. In reality, however, this sounds familiar, right? The cash resided in only one bank. Bankers at the time referred to the reserves composed as float as fictitious reserves. That's what's happening right now. The quantity of fictitious reserve rose throughout the 1920s and peaked just before the financial crisis in 1930. Okay, that meant that the bank system as a whole had fewer cash or real reserves available in emergencies. What's happening right now, guys? There's no cash in the system. So look at this. So this is important to understand for your education, for your family to know this. Send this to the baby boomer parents. Okay, look at the buying power. Okay. And we're in a similar position right now where banks don't have our money. Okay. So this was the banking collapse of 1930. 8,000 people were part of the Federal Reserve. They collapsed those banks, and obviously more banks are part of the Federal Reserve now. You do your math on why that happened. Okay. And then another dramatic thing that's really important for you to understand, in 1971, Nixon ended the convertibility of the US dollar to gold and announces wage price controls. Okay. With inflation on the rise, sounds very familiar, right? Inflation on the rise and gold runs looming, bank runs looming, right? People heading to non-bank financial institutions. President Nixon enacted a plan that ended the dollar's convertibility to gold and implemented wage and price controls, which soon brought an end to the Bretton Woods system. The reason why we detached from the gold standard, guys, is they didn't have the gold to back our dollar, just like they don't have the money in the bank right now. Very similar, not repeating, history often rhymes, right? But again, I'm going to take you back to this. Since the Federal Reserve was created, look at your buying power of your dollar, okay? So in 1971, we detached from the gold standard, making our money fiat, which is fake money, which is extremely important for you to understand, okay? So let's dive into this, okay? So if we go over here and we look at the petrodollar definition history, okay? So this is the petrodollar, very, very important. The petrodollar is basically the crude oil reserves dominated in US dollars. The term gained currency in 1970s when soaring oil prices. So basically in 1970, around 1970, when was this? 1970s, late 1970s, they went in the petrodollar, and all US dollars was traded in, all oil was traded in US dollars, which made us a very dominant currency. Okay. Then another thing that was created was the 401k was created, and it changed how Americans would retire. Okay, well, think about this morning. So if you have a fiat currency, a fake money, okay, a fake money, what would you do? Do you think you would continue pensions if you have a deflating dollar? Remember the chart of the deflating dollar? As a company, why would you have a pension? The American dream died after 1970. Even the father of the 401k, Ted Bennett, tells the Journal with some regret that he helped open the door for Wall Street to make even more money than they were already making. Okay. So let's fast forward. Okay. So 1971, we had the detached from the gold standard, and there was a transition in 2009. The BRICS countries are created. Brazil, India, Russia, China, South Africa, and Saudi Arabia is now working to join in 2023. 19 other countries as well. So 41% of the world's population with 3.14 billion. So 2009, the BRICS countries were created, which does not include the United States. So write that down. Okay. Then if we jump forward here, on the same time, January 3rd, 2009, Bitcoin network was created by Satoshi Nakamoto. They started the blockchain. Interesting, the Genesis block. We still don't know to this day who created that. So the BRICS countries are created in 2009. This is where the transition started to happen in our financial system, right after one of the biggest housing collapses in history. Okay. Now we're going to listen to this video. Listen to the words that she says about the financial system. Very important. Okay. Very important to listen to what she said. There was a transition from 2009 to 2012. And I'm going to break down where we're at now.
Credit markets were still frozen. Bank lending was almost non-existent. The municipal market for debt was in deep disrepair, leaving states and localities cash-strapped. And again, we still were not out of the woods. We still had a lot of work to do. But as you can see from these slides, the financial firms were still very much feeling the loss. You can see this as you can.
What I want you to listen to is it's going to be a couple minutes in. Get your pen and paper. She's going to talk about the shock to the system. Then I'm going to show you what's happening now.
You can see what happened with triggering the worst Great Recession since the Great Depression, which ultimately destroyed.
So basically, it was the worst Great Recession since the Great Depression in 1929. That was in 2006 going into 2008. This is, she's going to talk about 2012, which was the other big transition. The FOMC was created, Future Oversight Committee, Obama's rescue plan, right? And the bank bailing committees were created in 2012, getting us prepared for 2023, the switch in your monetary system.
9 million jobs, shrank the economy by hundreds of billions of dollars. And the crisis was caused by, among other things, again, this housing boom, as shown in the slide that you can see. The severity of the crisis is also illustrated by the rapid increase in corporate bond spreads in the fall of 2008, as well as a dramatic fall in household net worth. And I do recall when I sold.
Now, we had the same thing happen. We had inverted bond yields going into 2023, which sucked the liquidity out of banks. A shorter treasury yield bond was more attractive than a 10-year, which sucked the liquidity out of the banks. We had an inverted yield bond this year, which was wild for the banking system.
Sold my house in 2009, not exactly the best time. So I think we were all feeling it. So one of the things that was very important at the time that we all came together.
And if you're first time watch this video, this is Rosie Rios, the 43rd Treasurer of the United States, who was the last person to sign a $100 bill and also sits on the board for Ripple, just for context.
Again, during this very unprecedented time, was a set of core principles that we worked on with both administrations. So again, this is working closely with the Bush administration so that when President Obama took office, there would be a natural alignment. And this strategy included these core principles that you see in front of you. A comprehensive, forceful, and sustained response. We needed to act quickly and consistently. A categorical promise to prevent a catastrophic failure of the financial system. And a pledge to support hard-hit families. It was working at all levels. Main Street, the inequality that existed and continued during that time, along with Wall Street, and the goal of mobilizing private capital wherever. But the aftershocks continued for years with subpar growth and low inflation into this decade. From an economic perspective, the global financial crisis highlighted that fiscal and monetary policy do work. There is a role for government, central banks, and global cooperation in putting free market economies back on track when they get into a downward spiral. But the work continued even beyond the Troubled Asset Relief Program. As I mentioned,
this is where it gets, you have to pay attention, get your pen and paper out. This is where you can pay attention. Guys, it doesn't matter what I say, what all these influencers say. They say they have insight. They're not moving the needle, guys. They're not the one changing the financial system. This stuff is methodically planned out. Problem, reaction, solution.
We set up the American Recovery and Reinvestment Act. And in addition to that, in 2012, Congress passed what was known as the Dodd-Frank Act legislation, which included unprecedented steps for Wall Street reform. As you can see in this slide, it included clear guidance for specific oversight over what were considered as our traditional banking systems, which now included traditional banks, but also non-bank financial companies, swaps and derivatives, hedge funds, investment banks, clearinghouses, and exchanges. It also set up the Office of Financial Research in order to look at the empirical data to foresee and perhaps even forecast any other anomalies in the system. It also included the formation of the Financial Stability Oversight Council.
Important right there. FOMC, which Gary Gensler was part of that council, the start of it, ironically sits on the SEC. Jay Clayton, right, sits on the Bank Bailing Committee, which was created in 2012 as well. They were preparing for this moment in 2012.
This includes all regulators within the federal government, including the Federal Reserve, and is chaired by the Secretary of the Treasury. This group is so important, especially today, as you see other innovative programs, whether it's crypto or other assets coming into light, that allow the government to act quickly and swiftly with those regulators in place, ready to go. So what were the key takeaways that we saw from the first financial crisis of 2008-2009 era?
This is important. Get your pen and paper out.
One, consumer behavior is the hardest to change unless there's a shock to the system, and I will introduce what that shock is in a minute. So debt, housing, spending, there were definitely patterns here, but there are now new patterns. The fundamentals of the job market have evolved. We now have the gig economy. So, for example, in the United States, here's a great question for you all. Is an Uber driver considered employed or unemployed in the US? The answer is, as is the case for most economic questions, it depends. In this case, if an Uber driver is actively seeking other employment, then he's considered unemployed. But again, those are factors that we would never have thought about in the previous economy that we are now faced with.
Previous economy, guys, they are transitioning into a brand new economy, a brand new way to do money, a brand new way to do your finances, a brand new way to track money.
Today. And of course, shifting key demographics will influence economic and social behaviors. There is a whole new generation of investing, saving, and spending that is coming to life in millennials and post-millennials, which I will also discuss in a minute. But in the meantime, welcome to the new disruptor. Certainly the pandemic has caused a social, political, and economic tsunami that we would never have anticipated. And I mean no one. So here I was serving eight years in the Obama administration, and again, that first period on the transition team, and I get the call again from the White House asking if I would come back to be part of President Biden's transition team. You can't say no. You just can't say no. So there I was again. It was in the middle of the pandemic, and our conditions were so different, and our transition teams were very, very different than.
Okay, so we're going to leave it right there. The transition team. She said you need a shock to the system. She was tapped by Biden to be part of the transition team, and for some reason, she joined the board of Ripple. And then ironically, in 2020, we know that this virus that shut down the world, there was a massive shock to the system, which changed consumer behaviors. It changed the way we did money. She was told to reduce coin and cash usage in 2012, but she couldn't, because of the Obama rescue plan, turn the printing machine on full blast. And when GDP growth goes up, she couldn't reduce coin and cash usage, but you need a shock to the system to change consumer behaviors. So here's where the transition starts. 2020, we had a massive shock to the system. Okay, then as we headed into 2023, okay, we had the collapse of banks. First Republic, Silicon Valley Bank, and Signature Bank were the second and third, fourth largest bank failures in history of the United States, respectively. Smaller only collapsed to Washington Mutual during 2007 and 2008. In 2019, the Federal Reserve trailing rules changed increasing minimum assets thresholds to 50 billion to 100 billion to reduce the number of required stress testing scenarios. So there's been a massive transition. The banks are in a liquidity crisis. America's at 120% debt to income ratio. Most of the debts held, a lot of the debts held outside the United States, about 30% by China and Japan. Okay, so America's in a really tough position, but there's a hero out there that they told you was an absolute fraud in 2017. BlackRock has responsibility to democratize investing, including crypto, Larry Fink says. This is July 14, 2023, when this very man told you that Bitcoin is used for money laundering in 2017. Jamie Dimon told you in 2017 that you're a criminal if you trade Bitcoin, and it's junk, but blockchain in 2020, 2021, he said blockchain technology and distributed ledger technology is here to stay. So your transition is now happening to blockchain technology, distributed ledger technology, on-demand liquidity, and BlackRock has a responsibility to democratize investing, including crypto. Well, why is it important to listen to BlackRock or think about what they're doing? The feds asked BlackRock to help an echo of 2008. So BlackRock was tapped by the Federal Reserve in 2008 to balance out the markets, and in 2020 to balance out the markets. The largest asset manager in the world, that basically from the minute you wake up to the minute you go to sleep, they have their hands in investing in most of the stuff. They said BlackRock has a responsibility to democratize investing, including crypto, says Larry Fink. He also says in his report to investors, he says that we have a tectonic shift in our system, which is the ESG, environmental social governance. Larry Fink sits on the board of trustees for the World Economic Forum, and the board of trustees' mission and job is to move the mission forward. Okay, so this came out, we saw all this stuff. Now here's the transition. Now we're starting our new wave of information and technology, and it's bringing this information to you guys. So Federal Reserve launches real-time payment system for the first upgrade since 1970. So as you were sitting there looking up at the sky at UFOs, which probably a lot more is coming to that, July 20th, 2023, the whole system flipped to real-time payments, on-demand liquidity. But here's the thing, guys, only 35 banks are on board. So the transition is here. Okay, and this stuff you can all take a look at. So let's recap. So in 1913, the Federal Reserve was created. Since 1913, your dollar is completely devalued. I don't know if there's a connection there, but it's 1913. It's gone straight down pretty much, and your dollar is completely devalued. Now, as you sit in America, you're 120% debt to income ratio. Most of our debt's held outside the United States. We're in a new transition of a banking system. They're worried about non-bank financial institutions. They're suing. They sued Ripple, the most well-run crypto company in the world. But ironically, the 43rd Treasury of the United States that we just listened to sits on the board for Ripple. Interesting. And she was tapped by Biden for the transition committee. I don't know. There could be connections there, family. So what I want you to understand is this financial education. So now you know how the system works, and you know the transitions from the system. You're not going to stop digital money. You're not going to stop programmable money. What you can do is get your family set up with the proper investments so that you can gain a large amount of wealth, because the working class is going to get wiped out, leveraged towards technology, pensions are going to die out, critical services are going to die out. The whole system is going to be completely different. There's going to be working poor and very, 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 very wealthy. Trillions of dollars now has been printed, guys. Think about the word trillion, how big that is financially. So inaction is action. What's going to get you there is discipline, consistency, done for a long enough period of time to change the frequency, which changes the reality. You can't go into a new reality with the old foundation. You have to change the foundation to rewire the situation. So I hope this information reaches you well. If you want to be part of our amazing community, over 7,000 warriors worldwide have been impacted by getting their shit together. We're not against anybody. We're not fighting an invisible enemy. We're working harder on ourselves than we do anything else. Mindset, fitness, understanding the whole ecosystem, our 5 pillars of wealth. We supported over 7,000 people in this transition. And you're around like-minded individuals. The fact is, most people are not going to change. Ignorance is bliss, right? Just fly with the wind, and let's argue about left. Let's argue about right, and fight about things that we literally can't change without changing ourselves. So I love you guys. I appreciate you. As we always say, warriors, rise. Have an awesome weekend. Talk to you soon. Love you guys.